live stream. All right, we are live, and welcome to the Spurl and Associates YouTube channel. We're here with Josh Spurl. He is coming to us from fabulous Las Vegas, and you can see he's got the sphere right behind him, so he must be in the Venetian. Josh, how's it going?
Pretty good yourself, Trevor.
Doing all right. So we're going to teach people about how to beat the odds of business and wealth today.
That's right. We're going to teach people how to beat the odds of business and wealth. I got the sphere in the background. Hopefully, it makes it a little more entertaining. So I thought I'd show it. But
Perfect. Sounds good. So what are we talking about today?
I mean, we're going to talk about the Canadian job market, and because normally today we'd be bringing everyone the Canadian job numbers. Normally, the first Friday of every month, you get the employment report coming out. But just the way it works out, where the 4th of October here, it actually doesn't come out to the 11th. So those who are following along on our Instagram channel, they might be wondering why is it not out today. It's just a little bit of a reporting anomaly is coming out on the 11th. I think the 4th is just too close to the end of last month, so they can't get it out the door on this Friday. So they insist on it being a Friday. So it's going to be next Friday. I guess we're going to see it. So, but we already know, I already know how bad it is, and I'll explain why. So,
All right. Yeah, let's get into it. So, do you want ready to start talking about the
yeah,
Instagram post and share some
yeah,
things with the folks? All right,
yeah. Let's
let me
pull up the
just get
first
that
one.
set up. All right. So, there we are. First slide, Canada Employment 2024 update.
So, like, I have last month's up there, and we see the 6.6 number, and we see that unemployment rate climbing and climbing and climbing from, 5.5% all the way up to the 6.6%. And people look at that, and that looks pretty scary. First of all, unemployment rate you have to take it with a bit of a grain of salt because it tries to estimate who's actually looking for a job. It also includes, people who are working who are underemployed, so it can be a little bit misleading. One of my favorite metrics is actually the number of full-time jobs, and you can see it's been relatively stagnant almost, all year from 16.6 million to 16.7 million, despite massive population growth. Okay, and median wages, it's not like we're being world beaters here. So this is the post that we normally bring people every Friday, and you can see the increase in unemployment. And depending on whose textbook definition that you believe, you really don't have unemployment until about 6%. Okay, so previous to 6%, you're never going to hit zero because people in transition, people looking, it's just not really a practical number for even a really hot economy. So, but over 6%, you usually have some consensus that you actually have unemployment. Okay, that's where we start. Okay,
Okay.
let's move on to the next one, Trevor, because I want to put this in perspective for people.
Sure.
Okay,
Yeah, let's take a look at this. It's called the Canada Unemployment Rate History.
yeah, and here's where I tell people when in doubt, zoom out. Always, when in doubt, zoom out. And you see unemployment numbers of 6.6%, and you're going to see a lot zoomed in the media. You're going to see a lot of people saying it's the worst ever. We're approaching numbers that we haven't seen since the financial crisis. I think okay, that's kind of true. But for those of us who those of us older millennials who were trying to get jobs in the late 90s, that's you know for historical perspective, it was tougher then, right? And so when you see the unemployment numbers now and people are telling you that they are brutal, they really aren't. Like when you look at a historical perspective, they're not as bad as what you would think. It's like there's something else going on that makes it feel worse than what it is. But when you start looking at the unemployment number, it's like that's not really what it is. And I see a lot of people like thinking like, well, the unemployment number must be way worse because it feels worse. And they're not wrong that it feels worse, but picking on the unemployment number itself is not necessarily, the be all end all. And the first retort people will get is like, well, what you want to do is you want to look at the Canada youth unemployment. And so that's kind of the 15 to
All
25
right.
year old, type group, and we'll click on that one.
There we go. Let's pull that one up. Here we are.
Same thing, right? And you can start to see numbers there that they can look, approaching 15%, approaching 15%, which sounds scary until you look at it in a historical perspective. And we've been here before in the 80s, we've been here before in the 90s. It's like, from a historical perspective, it's not great, but it's not, we're not in Great Depression type numbers here. And so the pain that most people feel in the economy, it's like, the employment market is not great, but it's not awful either. Okay. And even when, people say, well, but what about the youth employment? Because of immigration, people aren't being able to get jobs. It's like, yeah, they can't get jobs like they could get 2 or 3 years ago. But it's no different who is looking for anyone who is looking for their first job in the 90s. Like
Yeah.
it's just no. In fact, it's better. It's better than it was then. Could we be going back to those levels? Potentially. And that's why I want to prepare people, because they're going to see a number and that's going to come out next Friday. And some people are, going to say that the sky is falling. And it's like, that's not actually the case. It's going to look like it when you zoom in, it's going to look like a bad outcome. But when you zoom out, you start to realize that the unemployment rate is not that bad. And so here's where we have to, educate people and tell them it's like, okay, but why does it feel worse? Okay. And that's what the next posts, we'll get into. And this is why we put them out all the time, is these posts get into, you know, basically what how long it takes to buy desirable assets with those wages once you have that job. Okay. And so this is where it kind of starts to fall apart. And this is the pain that people are falling. It's like, yes, historically, it might be a little bit harder to get a job, more, than it was 2 or 3 years ago. Okay. Yes. But it's not as hard as it was to get a job in the 90s or the 80s. Okay. But why does everything feel worse? It's well, what this is showing you is once you get that job, your ability to buy those desirable assets, it's just not as big, right? And this is where you hear the boomers out there, and the boomers are telling people it's like, just stop buying the Starbucks and the avocado toast. It's like, it's not the Starbucks and the avocado toast that are that aren't that are the problem. Okay, you start to look at just like basically at an ounce of gold, right, which has been the base layer of money for 5,000 years. Once you got that job with median wages, you could buy an ounce of gold with 0.7 weeks of median wages. Okay, 0.7 weeks. So you're not even working 4 full days in the week, and you could have bought an ounce of gold. Now, the same median wages in Canada, it would take you 3 weeks to buy an ounce of gold. Okay, 3 weeks to buy an ounce of gold. Now that might not mean a lot, and same with the TSX. Maybe that doesn't mean as much to you. It's like you could buy the index with 12.7 weeks of median wages, and now it takes 20 weeks of median wages. So you might be out of work looking for something, or you see a tough job market and you're blaming the job market. It's like, the job market is not great, but it's not the real pain that people are feeling. The real pain that people are feeling is once they have that job, their ability to secure desirable assets in relation to hours worked has been diminished. And it's been diminished not in a year or even 10 years. It's been diminished for decades at this point. And where people really start to see it is in houses, right? Where, now it would take, previously it would take 300 change weeks to buy the average house in Canada, and now we're well over 600 weeks of median wages, right? And that excludes any tax effect, which this calculation is just assuming someone could buy the average Canadian house with median wages and not pay any taxes. So you never actually pay off the house in 600 weeks. Okay. Then we get to the fastest horse in the race. I always tell people, it's like, and I put this there because I'm trying to tell people the story of where this thing is going. 10 years ago, you could have bought a Bitcoin at 0.6 weeks of median wages, and now we're well up over 70 weeks of median wages to buy a Bitcoin, right? And so that is the fastest horse in the race. And so it this video is designed to give people a little bit perspective. Our goal of these videos is to how do we help the average Canadian get into that how do we help the average Canadian get into the top 20% of net worth? Okay. And it's really just it's a game of Moneyball, and I'm going to show you the next slide, because you have to understand is like this game is how do we get your hands on desirable assets, because our wages are going to get diminished. Then we get to
Okay.
Canadian
Here we
debt.
are. Yeah, debt to disposable income. This is a good one.
Yeah, and this is giving people, decades of long perspective on what happens. It's like where does the money for these desirable assets come from? Okay. It comes from debt. That's where all money, all fiat money comes from. Every fiat dollar, every paper dollar issued from the government, issued into existence, is lent into existence either by the central bank or commercial banks. Um, and so when you start to look at that, the overall debt load to disposable income, here's where you go from, a few decades ago that it was under 100% to now it's 176% of disposable income. And so you start looking at people's income levels, and their overall debt load is 176% of that. That's where it starts to get a little bit telling. And so our goal is to get your hands on desirable assets. And so I this is where I start to really take issue with the baby boomers, even the Dave Ramsey's telling people it's like, well, if you just didn't have debt, it wouldn't be you could work your way out of it. It's like the world that they did that in 20 or 30 years ago is different. It is different. That's not just a subjective statement. It is economically, mathematically different. Okay, the number of years, the number of weeks it takes of median income to buy desirable assets is different. Okay, the importance of debt in the overall structure is different. Okay, and people look at these things and thinking that this is going to come down. It's like, no, it's going to continue in the same direction. That's just that's just the direction of fiat currencies. And so
Okay. So what is the takeaway on this one? Like what is the point that you're gonna give people some hope and maybe a strategy to get desirable assets and maybe not become this tax slave and interest slave?
yeah, I mean, here's where it's going to be harder for most people. That's just um, there's no two ways about it. The average Canadian has it harder than they did before, but the rate at which those desirable assets are increasing over and above wages is speeding up. So if the average Canadian actually takes time to, turn off Dave Ramsey for a second and stop listening to the people who tell you that avocado toast and Starbucks are the only problems that you're dealing with and everything else is irrelevant, and they start to actually, see that these desirable assets are increasing over time, uh, you know, in relation to the wages, and that rate of change is actually speeding up, it actually provides an advantage. Okay. So someone who's starting from scratch with knowledge actually has a actually has an interesting opportunity to probably increase their net worth faster than they could 30 years ago. And but the problem is very few people actually have that knowledge to do that, right? So that sounds like a big statement, and most people will reject that statement when they first hear it, but it's simply because they actually don't have the knowledge, right? It's more, it's more important than ever to get rid of cash. And so I hear people like, oh, the first thing you want to do is have an emergency fund of 90 days. It's like, okay, you're going to have an emergency fund of 3 months or 6 months or a year and hold it in what? Cash? Like that emergency fund is no longer that emergency fund is no longer big enough a year later. It's not. it's losing 8% of its value. So, if you wanted to have a year, you get to the end of the year, now you only have 11 months. Now you got to start on the emergency fund all over again. Why do they do that? Because they're scared of volatility, and volatility and risk are not the same thing. So if you're holding assets that are going to go down in relation to the things that you want to buy, with certainty, like cash, your risk is certain. Your risk is 100% of getting debased by inflation. And so, what people need to do is learn how to get their hands on these desirable assets. You start and look at a house. Okay, a house is one thing. That's a hard bar to get to. But if you're trying to save in cash for the house, that's going to be very, very difficult. Okay. And then at the other point is when you but there are things that you can acquire. Okay, 30 years ago you wanted to start buying stocks. Okay, you're getting into a brokerage account that has quarterly fees, probably $100 or $200 every 3 months, and every time you want to buy or sell a stock, it's another $30. So 30 years ago, that's kind of what it looked like. But these days, you can get onto something like Wealthsimple and buy quality Canadian dividend paying stocks in an ETF very, very easily. And with fractions of fees. I tell people, we teach people in the boot camp how to get started with $100, $100 a month. Everyone can do it for $100 a month. And the tools that you have today are far superior than the tools that you had 30 years ago, where it just wouldn't make sense to deploy $100 a month because everything would just get eaten up in fees. It wouldn't matter at all. And so once you start to learn how to build that nest egg, okay, that actually spirals quicker and quicker over top of wages than it did 30 years ago. But the key is getting started, okay? Then it turns into, how do you actually use debt? The people who know how to use debt properly. I mean, you want to buy your house in cash? It's like you're probably going to be poor forever. I mean, if you're only making median income, that's probably the outlook of that. Okay, but if you know how to use debt responsibly, if you actually know how to use quality debt at the right ratios to buy desirable assets, um, the value of those assets goes up and up, and what you borrowed to actually acquire that asset, either stays the same or you're paying it down slowly over time. And that rate of change that those desirable assets are getting more and more valuable in relation to the wages, it's speeding up. And so most people are going to get crushed by this. But the people with knowledge, even starting from zero, they're at an advantage from the people starting at zero 30 years ago. But it's not the way one would think. Does that make sense, Trevor, when I explain it like that?
Yeah, that makes a lot of sense. So anybody can get started doing this. Well, the tools, right? The tools that we have nowadays are a lot better than they were back in the 90s. And also, I believe you had to be what's called a qualified investor to even open one of those accounts. You needed to have some good net worth before you even were able to open them to some degree to get started with those. And the fees were outrageous. So today, anybody can get started. You can open up a Wealthsimple or a Questrade account and get started today with your portfolio and purchasing quality Canadian dividend paying stocks. That provides some hope for people. I mean, if you can get 10 to 12% when the rate of inflation is, really around 8%, then you're winning on the difference.
Yeah, and so it's more important than ever that people actually get the knowledge, because the average person is going to get crushed by it, and they're going to tell you that it's impossible because that's it sounds better. If it was possible that they just had to increase their knowledge, it's like, well, that feels really bad. And so it's way harder. Don't get me wrong. Like it shouldn't be this hard. It shouldn't be that the people who understand money are more successful than the people who do things really, really well, do useful things really, really well. But that's kind of where we are, and it's not going to, not going to stop. So that's why we want people to, that's why we created this YouTube channel. That's why we do the boot camp. The boot camp coming up on November 5th. It is sold out, but I always tell people to get on that wait list because you'll get first dibs the next ticket. We keep the number of seats in that boot camp at a set level just because it is an interactive event, and there's just no way we could there's no way we could provide the same experience if we increase the attendance, because people wouldn't be able to ask their questions. The interactive nature would go away. So if you're out there, get on the website, go to spurl.ca, go to the boot camp, fill out the form, go on the wait list. And as soon as we have the next date to the event, you'll get first dibs on the tickets and you'll get them at the old price. But because I don't want people to think that there is no hope out there. And you see the big unemployment number and you see it just flashing through the news and you start to see that this whole thing is hopeless. It is actually not hopeless. It's so much better than that, if you actually up level your financial education, it is actually easier to build wealth. But that's the big if you up level your financial education, it's no right now it's trying to, if you do something really really well and you make a little bit more than your peers, it's like that's almost not as valuable as knowing how money and wealth works, knowing how to actually acquire desirable assets that are going to increase faster than your in value, faster than your wages, and learning how to use debt that's issued at terms that are relatively stable against assets that are increasing in price. So hopefully that's useful to someone. Hopefully it gives them some hope when they're going to be on blast next week when those unemployment numbers come out.
All right. Thanks so much, Josh. And we'll see you next week in studio. Have fun in Vegas.